Hello, and today we are discussing about index investing and specifically the risks of investing in index funds. So I have my colleague Dr. Gupta with me. Uh, Vikas, let's start with index investing is quite popular. Yes, definitely in the US, in India, it is becoming popular now, and specifically for global exposure, index investing is one of the kind of available medium, right?
Absolutely.
Uh, so obviously there are a lot of benefits in the sense that it represents collective wisdom of the market participants. It's a very diversified portfolio, so you are not typically, like, unless the index itself goes into those kind of few stocks become really overvalued or become extremely large, then the exposure
Sure.
gets skewed. But otherwise, the best good part is that it's kind of a diversified portfolio, so you are not exposed to a particular sector or particular uh, company or type of companies, right?
Sure.
But then still there are quite a few challenges and significant challenges that it contains. So let's talk about those. What are those risks, and then we can explain that better.
Sure. So there are three risks, primary risks, which we want to highlight here. One is the companies which are loss making, weak business operations, loss making, over leveraged, right? Lot of debt. So these kind of companies, no good investor would on their own invest in such companies. But they are part of the index.
Yes,
And so as an index investor or ETF investor, you
you
invest
allocate.
in those. Second, non-investable group of companies which is there are companies which do not have competitive advantages,
Right.
or are losing those competitive advantages. Now, again, those companies are not really investable, but as an index investor, you are investing in those. And then the third one is overvalued companies. Okay, or
Right.
let me say extremely overvalued companies. Now, again, extremely overvalued companies are no good investor would invest in those.
Right.
But as an index investor, in fact, here you are
You
investing
are,
much more.
yeah, you are
Okay,
allocating highest weight there, right?
highest weight to
Right.
the most
To
overvalued companies. Okay, so these are the three broad errors
right.
which you want to stay
Avoid.
away from,
Right.
ideally. But in an index investment, you are forced to do
Yeah,
those.
yeah, yeah, definitely. I think if someone would have shown me that, okay, this is the full index portfolio, and these all the problematic companies. So, would you want to invest in all of these, or would you want to take these companies out and then invest in the rest of the market?
Exactly.
So that would anyone do, but obviously because of the construct, and you end up buying everything, right?
Absolutely.
And maybe we can talk about few examples of companies from each pool,
Right.
and interestingly they are like very large companies, right?
Absolutely.
Known companies, tens or hundreds of billion-dollar of market cap, which the money that goes into these companies end up being zero, or not generating any significant return. So let's
Sure.
why don't you talk about some.
Sure. So let's take some examples. So we talked about loss-making companies or over-leveraged companies, right? So
Right.
if you look at the largest bankruptcies in the US market, okay, companies which went bankrupt, top four are banks,
Right.
okay, out of which top two are, I mean, the Lehman Brothers is one of the largest with some $600 billion. The second was Washington Mutual with around $300 billion assets. Third is Silicon Valley Bank with around $200 billion. Fourth is Silvergate Bank with around $100 billion, right? And the fifth one, which is a non-financial company, is WorldCom. Okay, so WorldCom in the .com post .com burst is when that was like $100 billion kind of asset. Okay, so we, rather than discussing the financials, where it's very easy to discuss and dismiss that it's over leveraged and it was taking risks, etc. But a non-financial company like WorldCom is an example, I would say, of what you have to be worried about when you are buying the index. Okay, so financials are anyway, that's a whole very large topic to discuss. So this is one example of a over leveraged loss making company, right? Second, let's come to the losing competitive advantage.
Right.
Okay, so there I would take the example, let's say, of Blockbuster. So Netflix came in,
Right.
and they were destroying the video rental business of Blockbuster, right? So it was losing competitive advantage. Or we can go to the chain store book chain. okay, Barnes and Noble,
Right.
and where Amazon was selling and
And
they were losing competitive advantage.
Right.
Or you could take BlackBerry, the
Right.
research in motion, where it was practically entrenched and it seemed to have a huge moat,
Right.
especially in the corporate world and especially within the corporate world, the financial service industry, right? Because it had some taking care of compliance, all those kind of things were like all well entrenched.
Right.
And still, once the iPhone came and all those smartphones came in,
They
within a
lost,
very
their
short time,
right.
that competitive advantage was gone. Okay.
Right.
So this is the second group.
Right.
Now we come to overvaluation. Maybe you want to talk about overvaluation?
Yeah. So
Examples?
even like eroding competitive advantage. I think energy sector also in the last 10 years been a very good example, right? A lot of oil companies have lost their advantage because the oil itself is becoming in question whether how much and do we really need our oil after let's say 10 years or so
Because of
with,
electric vehicles.
Electric vehicles mainly, right? So Transocean is another, which is one of the highest, like losing money in the last 10 years. It lost more than 95% of its value, and it was a very very. I remember like it used to come for campus placements, and it was seen as one of the best jobs that someone can land with. And they had a specialization in deep sea drilling and offshore drilling, right? With advent of shale gas, that requirement shale oil, right? That requirement went down, right? Because now you could dig faster, though you will draw out lesser or for shorter period, but you can it's much easier to
cost is also much less,
right?
Time to dig and get payback is also much less,
right? So
and the probability of payoff is much more.
Plus, overall, there was a oil, glut. So crude glut was there. Demand was anyway, kind of not there. So all that competitive advantage of one of the best companies to have this kind of a, capability.
Right. It's a very rare capability, and even now it's a rare capability. But does anyone need it?
Right. So that happens. Similarly, and again, these are known companies which had very clear persistent advantage, which got out of hand, and people probably loved them at that time, and they were maybe overvalued, and compared to their reduced or deteriorating fundamentals, right? But then overvaluation is the third pool that we were talking about, and clearly there are companies which at the peak of euphoria everyone wants to go crazy about, right? I think on overvaluation, one more example, like very known name is Coca-Cola, and at the peak of 1998 or something, it would have a very high weight again in the index, right? And for next, I think 15-16 years, it didn't make any money. Like investors didn't make apart from whatever.
If you held it for 15, in between it would have gone down.
Yeah, significantly it went down, right? So the known name, the leader, Buffett club,
Buffett's one single investment,
and he's still losing money on not making any significant returns.
Absolutely.
Right? That's another risk of going
index,
to the index
investing.
Great. So how do what's the way out? What can investors do about it?
So great question. And see, scientific investing framework is designed exactly to counter these kind of errors, or these take out these kind of risks or minimize these kind of risks, right? So scientific investing framework, where we take out capital destroyers, which are loss making companies with weak business operations and weak balance sheets. Second, take out capital eroders, which are companies which are losing or don't have a competitive advantage, right? And third one is take out capital imploders, which are basically overvalued companies, right? So these are the three things we take care of in the scientific investing framework. And then you can, within the scientific investing framework, you want a systematic strategy, more passive looking strategy, then it's scientific alpha series of strategies we have. And if you are okay with the active strategies, then it is the scientific investing strategies.
Great. So with that, we conclude this discussion. Hope you found it insightful. Thank you so much for joining.
Thank you.